Hey everyone, and welcome to this explainer. Look, artificial intelligence is practically the only thing anyone is talking about right now, right? It's loud, it's confusing, and honestly, the whole debate around it has just kind of spiraled out of control. So today, we are cutting straight through all of that noise. We're going to decode what is really happening beneath the surface of this massive AI boom. And we're not going to rely on hype. Instead, we're looking at a hidden economic engine that has literally driven markets for centuries. Stick with me here because I promise, by the end of this, you're going to see the entire AI frenzy in a completely different light. All right, let's just dive right into it.
So right now, if you look at the discourse online, there is this massive, unavoidable divide. On one side, you've got half the internet screaming that AI is the biggest, most dangerous financial bubble in human history. And then on the other side, people are screaming just as loudly that it's the most important technological breakthrough since sliced bread. But here is the really uncomfortable truth we need to talk about today. It absolutely does not matter which half is right. Seriously, both sides are entirely missing the real story here. And that's because they're both arguing about the exact same, highly distracting metric.
And that metric? It's demand. Everyone out there is hyper-focused on user growth, adoption rates, top-line revenue. But here's the thing about demand. It is incredibly noisy. It's totally driven by narrative, and honestly, it can even be faked. The real secret? The world's absolute best, smartest investors, they just ignore the noise of demand altogether. Instead, they quietly track the supply side. Why? Because you simply cannot fake the massive, undeniable amounts of upfront capital required to build out that supply.
To really grasp the sheer scale of the supply being built right now, you just need to look at this one single number. Big Tech is projected to spend an almost incomprehensible $725 billion on artificial intelligence infrastructure this year alone. Now, when most of us see a figure like that, we just scroll right past it, right? It doesn't register. But really think about it. $725 billion. Our brains just aren't wired to process what a number of that magnitude actually looks like in the real world.
So let's break this down to put it into some kind of perspective. Imagine if you had spent $1 million every single day starting from the exact day Jesus was born. Like literally living through the Roman Empire, the Renaissance, both world wars, and, whatever the 1980s were, all the way up to today. You still would not have spent as much money as Big Tech is spending on AI just this year. That breaks down to roughly $2 billion a day. That's $83 million an hour or $23,000 every single second.
So the natural question here is, okay, are we in a bubble? Well, historical data actually shows us that world-changing technology and massive financial bubbles almost always go hand in hand. In fact, a study looking at 175 years of innovation found that 37 out of 51 major technological breakthroughs between 1825 and 2000 triggered massive speculative bubbles. The billionaire investor George Soros really hit the nail on the head. He said bubbles don't just grow out of thin air. They're based on a solid reality, like a groundbreaking new tech, but that reality simply becomes distorted by a misconception.
Part 1. The Capital Cycle Theory.
To understand exactly how this distortion works, we use this really fascinating economic framework, with roots going all the way back to Adam Smith in the 1700s. It completely ignores the hype and focuses purely on how money actually flows through an industry in 4 totally relentless steps. First up, you have the flood. A shiny new technology appears, the returns look absolutely amazing, and capital just pours in. Then comes the boom. Money keeps flooding in, and competitors start piling in way faster than actual demand can even grow. Step 3 is the collapse. All that brand new supply completely gluts the market, which crushes the very returns that attracted the money in the first place, and that leads to widespread bankruptcies. And finally, step 4, the inheritance. The original pioneers and builders are wiped out, and new players swoop in to scoop up all the leftover assets for literal pennies on the dollar.
Part 2. A History of Bubbles.
Now, this isn't just some abstract theory we're talking about. It's a proven historical reality that happens over and over. Let's just step back in time for a second. In the 1830s, capital flooded into Victorian railways. Investment hit a staggering 7% of the entire UK economy. Then, flash forward to the late 1990s, telecom companies buried over $500 billion worth of fiber optic cables. That is around 80 million miles of cable in the ground. And more recently, in the 2010s, capital rushed into shale oil fracking. It doubled U.S. oil production and literally made America the largest producer on Earth. In every single era, a massive flood of capital chased the hottest new innovation. But here's the catch. Across all 3 of those centuries, the outcome was identically devastating for the pioneers. When that boom finally turned to collapse, The railway index was slashed in half by 1850. Fortunes just vanished. During the 90s tech crash, a wild 85% of that fiber optic cable sat completely unused in the dirt while stocks absolutely cratered. And in the 2010s, oil prices collapsed from $100 a barrel down to $30, triggering over 200 bankruptcies. In every case, oversupply inevitably led to massive market crashes and a ton of unused infrastructure.
Part 3. Inside the AI machine.
Okay, so let's shift back to the present day. Just how dependent are we on this current AI cycle? Well, according to data from Harvard economist Jason Furman, investment in the AI build-out is only about 4% of the entire U.S. economy. But, and this is wild, that tiny 4% is holding up a staggering 92% of all U.S. economic growth right now. Strip AI out of the equation and the rest of the economy is barely growing at all. Basically, the entire economy is currently clinging to this one single bet.
But remember earlier when we said demand can be faked? Well, in the 90s, telecom companies faked their demand by telling these tall tales about internet traffic doubling every few months. Today, in the AI space, it's kind of being faked with circular money. Look at how this flows. NVIDIA funds OpenAI. OpenAI takes that money and pays Oracle for cloud services. Oracle then takes that exact same revenue and uses it to buy more NVIDIA chips. It's essentially a setup where companies are funding their own customers to buy their products. The same pile of money gets passed around in a big circle, but, and here's the kicker, it gets counted as brand new revenue, brand new demand at every single stop. It creates this totally massive illusion of booming organic growth. So really, the next time you read a headline about exploding AI revenue, keep this little loop in mind.
And despite all this manufactured demand, Adam Smith's old rule from the 1700s is absolutely still in play. Perceived high returns attract incredibly intense competition. Think about it. Just 2 years ago, OpenAI's ChatGPT stood virtually alone. Fast forward to today, and they are facing down Google, Anthropic, Meta, xAI, and honestly a dozen others, and they are all selling highly similar products. This right here is the textbook definition of the late boom stage. The flood of capital has officially brought the competition.
And that competition, it is already severely compressing returns. Just take a look at these leaked financial projections for OpenAI, literally the hottest company in the industry. Their total losses have surged to an estimated $38.5 billion. But the real red flag, the thing you really need to pay attention to, is that second number. They're projected to spend $5.7 billion just on sales and marketing. That is a 400% jump in a single year. They are basically burning through nearly half their revenue just to convince people to keep using their product while competitors are breathing right down their necks. The cracks are definitely showing.
We are also seeing exactly how fragile this late-stage boom has become in the broader market. A great example happened recently when the chipmaker Broadcom missed its internal AI sales targets by a mere few $100 million. For a huge company like them, that is practically a rounding error. But the fallout from that? Roughly $300 billion of market value just vanished in a single trading session. When a market is priced for absolute flawless perfection, a tiny little slip can literally erase $250 billion in the blink of an eye.
Part 4. Pioneers versus settlers.
Which brings us to the absolute most important question of all. When this inevitable collapse finally transitions into the inheritance stage, who actually wins? Well, looking at history, it is rarely the first movers. Think back to early search engines like Alta Vista or early rideshare apps like Sidecar. They were the pioneers. They took the big risks, they fought those brutal early battles, they bled the cash, and ultimately they proved that a massive market actually existed. But they didn't win. The settlers, companies like Google and Uber, they simply waited. They totally avoided taking those fatal early hits, swooped in, inherited the infrastructure and the market conditioning that the pioneers already paid for, and they took the ultimate prize.
There's this old, kind of brutal line in business. The pioneers get the arrows, and the settlers get the land. It perfectly summarizes this entire capital cycle. So as we sit here watching hundreds of billions of dollars just pour into artificial intelligence infrastructure, it really is time to stop arguing over whether AI is a bubble or a breakthrough. Honestly, it's almost certainly both. The real question you should be asking yourself as you watch this unfold is this: when the floodwaters inevitably recede, who is going to drown from the arrows and who will be left standing to inherit the land? Thanks so much for joining me for this explainer. I really hope it gave you a totally new way to look at the market.